Welcome to the 5th edition of LuxCMA Capital Market Day. Who recognized this song? What is it? Which song? AC/DC Money Talks. Released September 1990, so 36 years ago. Why did I choose this song? Because we will talk about money tonight. Not as it was 36 years ago, but as it is today and tomorrow, digital. Ladies and gentlemen, money talks, and today, Luxembourg Capital Markets speak loudly. Dear members, distinguished guests, friends, partners, and of course, future members of LuxCMA, it's a real pleasure for me to welcome you here today. My name is Holger von Kreuz. I'm the treasurer of LuxCMA, and I will be your master of ceremonies tonight. Let me briefly guide you through the agenda today. We have a structured program around a very clear flow. We start with money itself, settlement, central bank digital currencies, the digital euro. Then we move to infrastructure, so how digital securities actually work. Then we zoom into Luxembourg's new securitization law, just in a 10-minute espresso session. And we close with 2 panels on market evolution, securitization, and private credit. So, from concept to execution to market reality. This year's the message is simple. Capital markets are not just evolving, they are being rebuilt. And Luxembourg is not just participating, we are helping to shape that future. To officially open the event, it's my pleasure to welcome Frank, our chair, on stage for the opening words. Frank.
Thank you, Holger. So, ladies and gentlemen, distinguished guests, dear colleagues and friends, it's a great pleasure to welcome you to the 2026 edition of the Luxembourg Capital Markets Day. Let me begin by thanking you all for your presence and your continued commitment to making Luxembourg one of Europe's leading financial centers. Your engagement across banks, asset managers, law firms, regulators, infrastructure providers, and public institutions is what gives this ecosystem its unique strength. Today's agenda focuses on subjects that are not only highly topical, but truly strategic for the future of capital markets. I mentioned the ECB initiatives Project Pontes and Project Appia, the rapid development of digital bonds, and the ongoing reform of the Luxembourg securitization framework. These themes are not isolated developments. They are part of a broader transformation of our financial system, driven by structural economic shifts, technological innovation, and global competition. We are meeting at a time where the economy is undergoing profound adjustment. After more than a decade of low interest rate and abundant liquidity, we are now in a very different regime. Rising inflation, global tensions, and higher interest rates have changed the investment environment. And for capital markets, this has several implications. Higher cost of capital, renewed importance of risk transfer mechanisms, including securitization, greater demand for diversification and liquidity, and importantly, a stronger role for Europe to finance its own growth and strategic autonomy. In this environment, capital markets are not simply a financing tool. They are a strategic asset for economic resilience. Europe has long recognized the need to deepen its capital markets, yet their progress remains uneven. This is precisely where centers like Luxembourg have a critical role to play. Luxembourg's success has always been built on 2 pillars. First of all, stability. We benefit from a trusted, predictable legal and regulatory environment. And secondly, agility. Luxembourg has the ability to adapt quickly to market developments. And what's remarkable and very relevant in today's context is how Luxembourg continues to demonstrate both. Over the past years, we have seen a clear determination from the Luxembourg government and especially the Ministry of Finance to modernize our legal framework, ensuring that it remains not only robust, but also forward-looking. This responsiveness is essential in a world where competition between financial centers is intensifying, not only within Europe, but globally. And importantly, this modernization is not theoretical. It's being translated into concrete legislative initiatives. And the prime example of this is the reform of the Luxembourg securitisation law. Luxembourg is since long a leading jurisdiction for securitisation structures, offering flexibility, legal certainty, and investor protection. However, the market has evolved significantly, driven by new asset classes, investor expectations, and regulatory developments. The recent reforms that have been announced are therefore significant because they enhance operational flexibility. They clarify and simplify structuring options, making Luxembourg even more interesting for complex transactions. And they strengthen legal certainty, which remains a cornerstone for investors. In the current economic climate, where risk distribution and balance sheet optimization are becoming more important again, securitization is regaining relevance. And Luxembourg has decided that it positioned itself to capture this renewed demand. At the same time, we are witnessing important initiatives at the European level, particularly from the European Central Bank. Projects such as Pontes and Appia reflect a broader ambition to modernize the financial market infrastructure and to explore how technologies, especially DLT, can be integrated into central bank money and settlement systems. While each project has its own focus, they all share a common objective: improving efficiency and speed of settlement, enhancing interoperability across markets and infrastructures, reducing fragmentation within the European financial system, and preparing for a future where digital assets and tokenized securities play an increasing role. These initiatives are critical because infrastructure is the backbone of capital markets. And this brings me to digital bonds. We are now moving beyond the phase of experimentation. Tokenization is no longer a purely conceptual innovation. It is gradually becoming operational. Digital bonds have already demonstrated several potential benefits: faster issuance and settlement cycles, improved transparency and traceability, reduced intermediaries and operational costs, and enhanced accessibility for a broader investment base. However, the true value of digital bonds will depend on scalability, standardization, and integration into existing market infrastructures. Luxembourg has taken important steps in this area, including adapting its legal framework to recognize securities issued on the DLT. Once again, we see the same pattern: anticipation, adaptation, and implementation. It is important to underline that all those developments take place in a highly competitive global environment. Financial centers around the globe are investing heavily in digital infrastructure, regulatory innovation, and talent attraction. For Luxembourg, remaining competitive means continuing to move quickly while maintaining legal certainty, engage actively with European and international initiatives, and leverage its ecosystem where public and private sectors work closely together. One of Luxembourg's defining strengths is precisely this public-private partnership. It allows for pragmatic approach, for pragmatic solutions, informed policymaking, and efficient implementation. And as we look ahead, several priorities emerge: deepening European capital markets, integrating digital technologies into financial infrastructure, maintaining a balance between innovation and stability, and ensuring that Luxembourg remains an attractive place to raise and invest capital. None of these objectives can be achieved in isolation. They require dialogue, collaboration, and a joint vision. Ladies and gentlemen, today's agenda reflects precisely these challenges and opportunities. We will discuss how central bank initiatives are shaping the future of financial infrastructure, how Luxembourg continues to refine its securitization framework, and how digital bonds are redefining capital market transactions. These are not incremental changes. They are transformational shifts. Luxembourg has shown time and again it can adapt, innovate, and most importantly, lead. There is every reason to believe that it will continue to do so. And let me conclude with a simple observation. In times of change, speed matters, but direction matters even more. Luxembourg's strength lies in pursuing both. Thank you very much for your attention, and I wish you all an excellent and insightful conference. Thank you.
Thank you, Frank. Let's begin where everything begins in capital markets: money, settlement, trust. These foundations, as we have heard, are currently being redefined through digital currencies, new settlement infrastructure, and digital innovation. It is therefore a real privilege to welcome someone who is not observing this transformation, but actively building it. Dimitri Patin, the Deputy Director General at the European Central Bank. He's part of the senior management team within DG MIP, responsible for market, infrastructure, and payments. In that role, he oversees ECB's target services for payment and security settlement, infrastructure used by banks and market participants across Europe. Before joining the ECB, he spent many years at Euroclear. So if there's anyone in Europe who has seen settlement evolve from theory to reality, it's him. He's also driving some of ECB's most important initiatives on tokenization, the projects Pontes and Appia. And today he will cover the work they do in tokenization and explain why ECB is engaging into this journey and what will be their approach for it. So if some things is settled in Europe, there's a good chance that Dimitri has something to do with it. Dimitri, welcome on stage.
Thank you. The first lesson is don't believe everything this man is saying. Good afternoon, and thank you for having me here today. I will focus my intervention today on the work that we do, as was just explained, in the field of tokenization. I will explain why we engage into this and also what we do, because I think this deserves to be explained for sure. Let me start on the why we do this. Let me start with an observation that we have made, that I guess you have made, and I guess everyone has made. Financial markets today stand at the crossroad of two profound transformations. The first one is geopolitical. We see day after day and with the naked eye that the world is becoming more and more fragmented, more and more transactional, and I would even dare to say more and more adversarial in some respects. In such environment, critical infrastructures can easily become a means to an end. So they can be a lever for geopolitical influence. And market infrastructure are critical infrastructure in Europe. And unfortunately, Europe is quite exposed to this. Let me give you one example. It's in the field of payment, but I believe it's quite telling. Today, 2/3 of payments, of card payments in the euro area rely on international payment schemes, or card schemes. 13 out of 21 euro countries rely exclusively on those international card schemes also to do domestic payments. The second transformation is technological. Distributed ledger technology enables a shift of business to tokenized platforms and allow assets to be traded, settled, and stored with a higher speed, more efficiently, and also with programmability. And these two changes, geopolitical and technological, require that we deploy a cohesive, forward-looking action. To that end, we at the ECB and on behalf of the Eurosystem, we published 3 months ago a comprehensive payment strategy. What is interesting is that the previous version was called retail payment strategy. So it has changed into comprehensive payment strategy that shows a bit the ambition. And in that strategy, you can find four main goals. The first one is to maintain the key role of central bank money in wholesale markets. This is to ensure the effectiveness of monetary policy, financial stability, and also the smooth functioning of payment system. The second objective is to achieve strategic autonomy and increase resilience. And the words are well chosen. We say achieve. We don't say, sometimes we say support, but we never say preserve, because you only can preserve what you have. And today we believe that there is a gap in terms of autonomic strategy in Europe. The third objective is to foster integration, competitiveness, and innovation. And the fourth one is to support, it's probably more Eurosystem-centric, it's to support the international role of the euro across the globe. In this strategy, which I encourage you to read, it's on the website of the ECB, we explain the digital euro. I will not go into the details of digital euro today for two reasons. One, it's not my area of responsibility, and I believe it's also a bit less relevant for the audience today. But in that document, you would find, that strategy document, you will find digital euro. You also, for instance, you will find the work that we do to enhance cross-border payments. I'm referring here to the interlinking between fast payment systems. We are quite active in that field. But more importantly for the speech today, you will find that strategy, and here I will read that we recommend that the transformative potential of tokenization should be seized. So what does that mean, seizing the transformative potential of tokenization? In traditional settlement or in traditional markets, the full life cycle of a transaction covering issuance, trading, settlement, custody, and asset servicing is typically spread across multiple platforms, different and operated by different actors, each requiring deep reconciliation several times. With token-based technologies comes the ability for a token to carry more data, and maybe the data that is required to support the full life cycle of the asset. Smart contracts can then automate what today often requires manual intervention and, again, complex reconciliation. It is this combination of rich tokens and the logic built in smart contracts that makes it possible, in principle, to consolidate all of these steps into one single shared environment. I'm not saying one actor, I'm referring to an environment. These are not marginal improvements, this is really structural. And market participants recognize more and more the promises of tokenization by engaging into real transactions. If you look at what happened over the last 2-3 years, and the previous speaker mentioned that, over the last 2 to 3 years, for several asset classes, there has been a move from experimentation to pilot in production, sometimes recurring ones, and also with larger size. In terms of actors, we see more and more traditional financial institutions not leaning back. They are engaging quite actively in the field, and this is a good development. We have also observed the same in terms of infrastructure. So beyond the assets covered, beyond the actors in terms of infrastructure, more and more platforms exist supporting the issuance, the settlement, and the custody of tokenized assets. So our assessment today is that the tokenization of EU capital markets has moved from the stage of experimentation to more and more production-grade services. Still, we believe we are at this stage, in the early stage of maturity. This is all good, but in order to grow in maturity and scale, we have identified two main obstacles. The first one is the absence of a safe, natively tokenized settlement asset. And the second one is fragmentation of DLT networks, which today operate largely in isolation one from the other. Unless those two main obstacles are addressed, the efficiency gains will remain trapped into individual platforms, and the liquidity that makes markets deep and competitive will not materialize. removing the first obstacle, to remove the first obstacle, tokenized central bank money can be the safe, trusted, and scalable asset that is needed. The need for such tokenized form of central bank money is precisely why we do Pontes. Pontes means bridges in Latin, and with Pontes, it will be possible for an issuer or for two participants wanting to exchange digital form of assets to organize the cash leg using a tokenized version of central bank money. At the current juncture, this will be possible by means of interoperability between a market DLT and the target services via a Eurosystem DLT platform hosting the cash tokens. And this is happening tomorrow. This is happening very soon. The launch is foreseen in September this year. We actually leverage on 5 years of work done by several central banks within the Eurosystem. We were lucky from that angle. Some insights on where we stand today. The infrastructure is in place, it's installed. For those who are a bit deeper into our methodology, we have a delivery and then we do the acceptance of the system. The system acceptance is ongoing and well advanced, and the start of the testing with the users will come in 4 weeks from now. I mentioned our comprehensive payment strategy. And I mentioned it, that I did not mention, but I want to highlight that it also clarifies what is our stance in terms of other settlement assets. We talk about central bank money, but I'm referring here to tokenized deposit and stable coins. From our perspective as central bankers, but it's also in the mind of many other players, it is of essence to preserve the two-tier monetary system. On one hand, you have central bank money issued by the central bank and acting as risk-free settlement asset. And on the other hand, you have commercial bank money backed by central bank reserves. Wholesale central bank money, central bank money, a tokenized version, is the safest asset that there is. It is the anchor for financial stability, for settlement finality, and ultimately for the singleness of money. We have made tremendous progress over the last years, and I'm referring now since the global financial crisis in 2008, and I'm referring to the PFMIs, which are positioning the central bank money at the core of what we do. This must not be changed. It must stay like this, and it must be carried over in the tokenized world. Following the same logic, we believe that other private settlement assets, tokenized deposit and stable coins have their place in the ecosystem. We believe that tokenized deposits are probably better suited as a private settlement asset. However, they need to gain scale, and to gain scale, they need to become transferable. Euro-denominated stable coins could also play a role for specific use cases, but they need to be EU-governed and well-regulated. This is, amongst others, what you can find in the comprehensive payment strategy. Coming back to the two obstacles I mentioned, I covered the one of the absence of a safe settlement asset, but delivering Pontes will solve that one. It will not solve the second problem, which is fragmentation. During the work that we did in 2024, we did extensive exploratory work. We have seen in general a proliferation of entirely isolated DLT networks with no connection between them. And this is no blame, this is normal at the start of a new era. This is what you could expect. But because the barriers to launch a DLT network are much lower than building a traditional market infrastructure, the risk of further proliferation exists. The problem is that if such fragmentation continues, it will undermine the mere benefits of the tokenization, what the tokenization can deliver. And to overcome this fragmentation, we must support the emergence of shared utilities. And because the prospect of having only one unified ledger is not necessarily credible. We believe that common standards must also emerge. And this is what we will do with APIA. APIA is the Eurosystem initiative to co-design together with the industry an integrated European tokenized financial ecosystem. It will be a combination of analytical but also a lot of practical work to assess possible DLT network configurations and the extent to which these configurations support achieving the objectives that I mentioned 5 minutes ago. In an ideal situation, DLT networks should function as a basic infrastructure on which the public sector and market players provide their services. This should be operated under European governance and should share common standards to ensure adequate interoperability. The work under APIA is organized around 6 building blocks. Don't be worried, I will not cover the 6, but I will cover the 2 first building blocks. The first one is quite foundational. It is covering the interoperability between DLT networks and also standards. In a landscape where multiple networks would coexist, the transferability of assets from network to network is essential. We plan to conduct analytical and practical work on such transfer mechanism and also on the ability to keep sufficient control on the assets when they are transferred. A key ingredient to achieve interoperability is to support interoperability and avoid fragmentation is standards. Standards entails designing and agreeing on data formats, smart contract templates, communication protocols to allow the tokenized assets to move freely from one network to the other. But standards only work if they are adopted. That means that this cannot be done in isolation, and in the deep involvement of stakeholders across the line is key. The single building block is the one where the Eurosystem will investigate the conduct of monetary policy operations and collateral management on DLT. This building block links with the recent decision to accept DLT-based assets issued in CSDs as eligible collateral for Eurosystem credit operations. This took place on the 31st of March, so 3 months ago, nearly day for day. On that occasion, the Eurosystem did not make big secrets that it intends to expand the eligibility of those assets to other asset classes that are issued and settled entirely in DLT networks. This work that we will do under APIA will, for instance, assess whether it is possible to mobilize on DLT not fully operated by the Eurosystem the necessary assets as collateral and how sufficient control can be maintained on those assets. The answers to the question of the building block 2 will determine whether tokenized ecosystems can support the conduct of monetary policy the way it is done today with the traditional infrastructures. Again, I will not cover the other building blocks, but again, the roadmap for APIA is a public document. You can find it on our website. It was published on the 11th of March. The main product from APIA will be a blueprint with concrete design principles or preferences, and it is due by 2028. And I hear already some say, but this is, I heard you say speed is of essence. Of course, the work that we will do will be iterative. And each time we identify elements that would be no-regret moves, we would see how we can translate that into implementation. So it doesn't mean that we have Pontes and then we have APIA only 2 or 3 years later. So far, I tried to explain the why and the what, but maybe the last question I would try to answer today is why now? Why is it the right time now to do this? And I would like 4 reasons to believe that this year, next year, will be potentially an inflection point for tokenization. The first one is the trend that I just explained. We see more and more actors investing quite heavily in the technology, more and more stakeholder engaging, a higher trust in the technology, and also a higher trust in the benefits that the technology can deliver. The second reason to be positive about reaching very soon an inflection point is a strong push from the EU policymakers. With the MiCA regulation and with the DLT pilot regime, we have a good regulatory framework. It's fair to say that the DLT pilot regime was not a tremendous success so far. It suffered probably from the perceived the fact that it would be temporary, and also from certain caps. But the good news is that this is being remedied. You have very bright people working on to overcoming these problems and making the next version of the DLT pilot regime a success. The third reason for being optimistic is the one that I explained, and it has to do with the expansion of the eligibility of tokenized assets as eligible assets for collateral for Euro system credit operations. And the fourth reason, not surprisingly, is Pontes and Appia, so the availability of central bank money in a tokenized form to support wholesale DLT-based financial transactions. And hopefully the work that we do under Appia will also act as a catalyst. If I have 2 more minutes, I would, beyond explaining what we do in the tokenization, I would have still 1 or 2 words on the target services. For those who remember, 1 year ago we delivered ECMS, a unified collateral management system for Eurosystem credit operations, and the delivery of ECMS marked the end of a very ambitious program called Vision 2020. Don't ask me why Vision 2020. From the start, it was not meant to be delivered in 2020. On that occasion, we delivered 2 new target services. One is TIPS, the other one is ECMS. We renewed our large value payment system, so the target 2 became T2. We implemented CLM, so a centralized liquidity management module. And the main goal for us was to enhance the management of central bank money as a single pool of liquidity across the lines. The second objective was to expand the target services beyond the euro area by making the target services multi-currency. T2S was multi-currency from the start. T2 became multi-currency TIPS as well. ECMS is not the case because of the tight link with monetary policies, but it could become multi-currency as well. And we have been quite successful with this. I will not give you all the details of what we have been doing in terms of onboarding, but today Denmark is using T2S, since 2017. It's using T2, it's using TIPS. Sweden is already using TIPS, and it has plans to use T2S and T2 by 2030. They have signed a contract already. Norway and Iceland are a bit less advanced, but have also signed contracts. They will adopt TIPS, and then at a later stage, the 2 other target services, so T2 and T2S. And of course, when we talk about T2S, the CSDs are also joining. Euroclear Sweden will join T2S in September 2030. This is public information. We also see the attractivity of the target services growing. We have ATEX CSD, the CSD in Athens, the second CSD in Athens, has also plans to join T2S. The point I want to make is that over the last year, we have invested a lot in the target services. And my message today is we will continue to do so. So the reason for that is we do not believe that there will be a shift over 1, 2, 3 years into a full tokenized ecosystem. There will be a long coexistence. And the 2 examples that I would give in terms of future investments, we support fully the shift to T+1 for T2S. And we have also done heavy work to enhance the opening hours of T2. We plan to open windows during the weekend to mitigate the frictions that we can see in the weekend. The message here is we continue to invest in the target services. It's a great time for me now to conclude. I hope this was useful, but if you have to take 2 main takeaways from what I just explained, the first one would be what I finished with. Target services are doing well, and we continue to investing because there will be from our perspective, of coexistence, at least in the foreseeable future, between the target services and the tokenized ecosystem. The second point is that Pontes is coming. It will be coming in 3 months' time. It will be there. It will solve the problem of the availability of a safe settlement assets in the tokenized ecosystem. And we are also well aware that, we also work on API, as I explained, to foster more integration and competitiveness in the tokenized space. But again, we are well aware that on our own, we will not succeed. So if it's the Eurosystem doing that on their own, we will not manage. There is an element of direction. You mentioned direction. What we try to do is give the direction, show that we mean it when we say that we believe in tokenization and we want to be an active contributor to that. But this will not be done without a genuine public-private partnership. Thank you.
Dimitri, thank you very much. The keynote explored the future of money. This session now, the first panel, is about making it work. How do we move from proof of concept to real issuance, from pilots to scalable infrastructure? This panel will put a spotlight onto some of the actors and leaders in this space, showcasing some of very innovative use cases born and bred in Luxembourg. It's a pleasure for me to introduce our moderator, Thilo Dernbach, Head of Business Development and Commercialization of Digital Initiatives at Clearstream. He also spent more than 20 years in post-trade, so like Dimitri before, he knows the traditional settlement and he also has a view on today's digital and tokenized world. Thilo will moderate a panel with a range of local experts who have personally contributed to this positioning of Luxembourg in the digital space, which means if digital securities are supposed to work in practice, these people making sure that it will really work. Thilo, the floor is yours.
Good afternoon, good evening. Wonderful. As the colleagues sit down, and I'm sure most of you, if not all of you, know every single one of the colleagues here on the panel. So I will skip a little bit of time and move forward with the discussion itself, and you can easily read all the credentials of the individuals here. Let me quickly start perhaps by going back to the presentations and the speeches that were given by Dimitri and Frank. I think one of the elements that or the things that we would like to look at here on this panel is really the aspects of, or referring to the aspects of competitiveness of financial markets and financial centers. Frank referred to it, he talked about speed, but also direction. I thought that was a very, very good picture. It is not only about speed, but also direction. And Dimitri talked a lot about the transformational potential of digital technologies, more specifically blockchain technology, but also referred to the optimism that he has, which I actually share in regards to Europe's positioning based on some of the things that you've mentioned. Now, what I would like to do with this panel is actually kick the tires on the one hand side, the competitiveness of the Luxembourgish market in the European context, but in the global context as well, but also kick the tires a little bit on that optimism and see how well is Luxembourg positioned? How are the financial institutions and intermediaries in the market here positioned in that context? And this is what we're going to do to start. And I will start in no particular order, but I will start with you, Serge, and then we perhaps go on down the line. I'd like to baseline the conversation and clarify for everyone here in the audience, where does your organization stand today in that digital transformation? And what was that journey like? If it doesn't work, I'll just hand you mine. So what was the journey like of digitization, and where do you stand today? And from there, we'll look forward and see what has happened and what will happen in the future.
Thank you, Thilo. So, hi, everybody. So, as Purkes, as most of you know, we are a retail bank, local retail bank in Luxembourg. And in that context, We have obviously invested for quite a long time in our digitization capabilities for our clients on the retail space or corporate space. But obviously, recently, to something that actually is more relevant for this audience, we've decided to take a stake in the Keyvalence initiative, where we see there's a lot of potential for the bank to actually not only sit at the table of discussions at the time the digital euro is coming. So we see, as Dimitri was saying, that the Keyvalence solution helps us actually more or less at the same time as Pontes to come with central bank and commercial bank money. This is a decision that has been taken very recently. There's now about 37 banks who have decided to go on that space. And from that point of view, we think that moving together as an industry makes more sense than actually going on a standalone basis.
Super good. Thank you. Catherine, would you like to carry on from your perspective as LuxCSD?
Yeah, sure. So for us as market infrastructure, the journey has been kind of phased transformation, not a switch. And it started with a clear vision to build a kind of hybrid model where we will bridge the traditional finance with the digital world. And it started with our digital issuance platform, which is called D7, back in 2021 already, where we focused initially on a very simple product with the German CSD, and then we expanded in a stepwise approach. So we added more products, we included an API connectivity, and last year we connected the Luxembourg-based ICSD to build a DLT solution for Eurobonds product. So today, the state of digitization in our organization is that we are actively operating this hybrid model. We have moved beyond concept to provide live digital infrastructure. And now the focus is more on leveraging the Luxembourg legal framework to work with local partners. So that's where we are for now.
We'll double click on that in a second.
Yes.
Marcello, as EIB, you've been an early adopter. You've been trying out and testing the waters in many instances. Can you talk us through some of those initiatives and a little bit also what you concluded from those to arrive at where you are today?
Sure, thank you and good evening everyone. So at the EIB, of course, the digitalization is one of the key strategic missions of the bank because it links very well to all the other objectives that the bank as the European Union Bank has, so innovation, capital markets development, and the promotion of the EU strategic objectives. So at the EIB, we started our digital journey back in 2021, and every time we approach it with a step-by-step, let's say, mindset, which I call also brick by brick, because we try to build every time with one of the experience and project that we run, something new that stays, and then we are able to add on to this in order to develop and make it more accessible, hopefully, for the industry. You know? So we cooperated with a lot of partners in the Luxembourg environment, of course, with the BCL, the ECB. Thank you very much, Dimitri, for everything you've done, and you will see later. Clearstream, of course. And we started our journey, as I said, 2021, and we tested everything different. So 6 digital bonds, 3 different currencies, and every time we try to add a specificity. So zero coupon, then an interest-bearing solution, private blockchain, public blockchain. So we try really to leverage on every single project to try to develop and make it more accessible to everyone also.
Super good. And Laurent, as a representative of an international, globally, systemically relevant organization from Asia originally, tell us a little bit about the journey as an organization, but with a bit of a focus here also on Luxembourg.
So, of course, good afternoon to all of you. I was not there at the beginning of the journey because I joined Standard Chartered a year and a half, but I can tell you a bit the story. It's all coming from the statement from the top management that blockchain is here to stay. And our CEO used to say that most of the transaction will settle on chain. So we have no choice to move forward, and in terms of state of where we are, let's say that we are in the execution phase. We started to do some investment, and now we are more in the scaling phase. And we need to be present in each part of the value chain when it comes to the primary market, to the secondary market, to the post-trade, to the custody, and of course to the asset servicing. So definitely we are we are doing investment in each part of the value chain, and we try to get a solution for our clients. Also, from a Luxembourg perspective, indeed they chose Luxembourg for the MiCA and EMI location for Europe. Hopefully Luxembourg has been chosen, and we do the digital asset custody for Standard Chartered clients for Europe. So, and hopefully we get MiCA and EMI a week ago, just before the deadline.
So the hope from just this audience, and I'm sure it's relevant or relatively comparable with many of the people here in the room, that it's transformational times and it's a transitional period. And transformation and transition comes with time, cost, and effort. Transformation can be risky but can deliver opportunities. Of course, it's definitely a changing environment where competitive scenarios, competitive realities can also change. One of the things that, and Klaus, you were, Frank, sorry, apologies, you were part of these developments here in the domestic market. Of course, the government has created the regulatory frameworks necessary to allow the market to flourish. Many international organizations have come to Luxembourg on the basis of this, expecting or no, leveraging on the clarity of the regulatory environment, which is fantastic. And as you said, Marcello, you have used these frameworks successfully a couple of times. Now, just very recently, days ago, you have issued another DLT-based, so a tokenized bond, so a financial fixed income product, let's call it, generalize that. Talk us a little bit about that last experience, and what was the new thing about this? Because as you said, you already had some experiences. What was a new client experience or journey?
Thank you. So, as I said before, we try to always bring something new. So we started with many projects in the past years, and so we try also to innovate internally in the organization. So we try to spread the knowledge of digitalization across the firm. So we chose a project which is not a bond, but is a commercial paper, so very short-dated, so to try to test everything in a very short time frame, 10 days. We went with the issuance on the 24th of June, so 1 week ago. We settlement Friday, 26th of June, for a 10 days maturity. This is off the D7 DLT Clearstream platform, and we basically leveraged of this issuance to be, and I link this to Dimitri's speech, to be the first reusable tokenized security in the Euro system. So we reached if I remember well, I mean, honestly, when we started the project 6-7 months ago, we wanted just to do like an ECB trial-like project, so small amount, one investor, very, very tiny, right? Just to try to the pipes, let's say. The project eventually involved 5 investors, 77.5 million euro real notional interest, and the reuse of the commercial paper tokenized version in the Euro system with actual access to the ECB facility by 2 investors. So this is really what characterized the deal and made it a prime in the market, and we want to really leverage of this and try to expand this knowledge elsewhere in the Luxembourg industry, everywhere in the European community as well.
Wonderful. If I move on, perhaps, Catherine, a question to you, but please, the colleagues also contribute. Gilles Roth, and I will have to repeat what he said because I've written it down, with the Luxembourgish government being very supportive of the dynamic development of the Luxembourgish digital financial ecosystem. So we clearly have the support from the government here, supporting the market participants to grow. He also expressed or clarified that very recently they already issued a treasury certificate on DLT using under Luxembourgish law, and plan digital sovereign government bond issuance later this year. So we see more and more issuances, native issuances taking place now. I would say, I would still call those drops in the ocean, but increasingly these drops are gathering to a rain and hopefully a storm in a positive sense of new issuances. On the other hand, so this is the sort of native new issuance of securities. On the other hand, we have a stock of trillions of notional in the traditional market that had been issued in the past. DTCC announced earlier this year that they want to allow their clients to tokenize the 115 trillion of US dollars in securities and bring them onto the blockchain. Clearstream has announced recently that the 23 trillion that they hold in custody would be available for tokenization. Catherine, can you just walk us through, so that is what I would more call the ocean, in which we add further drops and rains and storm water, but can you tell us a little bit what that is all about? So why is this tokenization of real-world securities so relevant in this transition and this transformative time?
Yes. So tokenization of existing securities, it gets really to the very heart of how we scale digital asset market. And while digital native securities like the one of EIB or Lux State Treasury are the exciting frontier, as you said, the vast majority of today's assets still exist in the traditional systems. You talk about trillions of assets. So what is all about? It's about creating a kind of digital twin for existing securities. And the goal is then to bring all assets, whether they are born digitally or traditionally, onto the same platform. This would then allow the market participants to use their one single account, one single portfolio to manage both traditional and digital assets. Now, how does it drive the adoption? For me, it solves three main challenges. One, it unlocks existing liquidity, because instead of waiting for the digital market to grow from zero, we will have the existing liquidity pool injected into the digital world, right? So it's more scalable. It increases as well the asset utility, because once the asset is tokenized, then you can reuse it, with better velocity, better time to market, and as we just discussed, as a mobilization for collateral. And last but not least, I think it's really important, is that a client can use existing assets, the asset that they already hold. So it gives them as well the opportunity to explore the benefit of DLT with their own assets.
Mm-hmm. Please.
Yeah, and if I may, I think this initiative is key for a bank like ours, because it gives us the opportunity to test, and also if you look at scalability the scalability of that solution, it allows also for the different participants to progressively step up on the solution and to progressively adopt and adopt the benefits, obviously, of the DLT.
Yeah. Okay. So the direction of travel seems to be relatively clear on the securities side. From a low basis, you said zero, but indeed from a very low basis, we're seeing increasing number of natively issued securities. If we now add the ocean of traditional securities that are tokenized or re-digitalized, if you like, that should be a real tipping point. Now we've covered the security side of things. Sergio already mentioned Kivalis. Let's talk generally, and Dimitri rightly addressed the topic of wholesale CBDC, but also you referenced that there's equal use case and applicability of, I hope I'm paraphrasing correctly, of other money types and qualities. So commercial bank money as well as central bank money have their use cases and applicability in the traditional world, and they will have, we believe, these also in the new world. Commercial bank money comes in different forms, also in the digital manner. You referred to, rightly, to tokenized deposits and stablecoins. You referred to Kivalis. Talk us a little bit about the stablecoin environment, or generally the digital commercial bank money solutions. Yeah. But why Kivalis, why stablecoins, and what was the interest for you to invest into and become a partner in Kivalis?
Yeah, so when we were looking at the stablecoin growing in the US, and the fact that we were a little bit, from a European perspective, we were a little bit late compared to the US, we thought that actually the Kivalis initiative was a good opportunity for us to actually invest in a European-based solution, European-regulated solution, rather than ceding to dollar-denominated solutions around stablecoins. So the first, one of the reasons was actually to actually benefit from what Europe can bring to the market here. The second point is exactly what Dimitri was saying. Pontes is going live September this year. Kivalis has the ambition also to come with first use case in the second half of 26. So we think, just as you were explaining, that there must be a coexistence between central bank money and commercial bank money. We think that this is a way, although we still wait for the standards to come iteratively up to 28. But we think that, coalescing with 37 banks across Europe on an initiative that allows to work with on-chain digital euro and regulated by European regulators, that was a clear move for us. Then a third point, which is we are looking at with Kivalis, not necessarily as a first step, but more as a prospective look, is that Luxembourg financial center is also driven by the fund industry, and we think that there is a clear benefit to actually be able, on the one hand, to tokenize our funds assets, and on the other hand, to actually be able to settle it against a euro-denominated stable coin. So that is something that we think can bring a lot of benefits for the Luxembourg financial place.
Super good. Plus, we but we also get the possibility to conduct DVP transactions on-chain with the asset on security on-chain, plus the cash side on-chain. And perhaps, Laurent, to you also being a custodian in the domestic market for crypto assets, MiCA assets, what's your contribution in the Luxembourgish ecosystem to the ability to transact cash versus securities, to provide services in the digital ecosystem here with the products that you have, or the support that you provide as a custodian service provider here?
First of all, if you are not doing it in Luxembourg, the other will do. And definitely when you speak about digital securities, cryptocurrencies as a digital asset custodian, in Luxembourg they play a vital role. And I believe if you are the first fund center in Europe, we need to move forward first with cryptocurrency. Why? Because first we are the first fund center, and we have a lot of interesting projects, a lot of ETP, for example. They are going to choose Luxembourg in the future because we have the possibility to do it in Luxembourg. We have companies like that have chosen Luxembourg, but you have Coinbase and different other big players that are today in Luxembourg, and of course Clearstream. And so definitely it's a key topic for Luxembourg because it's a new asset class, and we need to work on that. But cryptocurrency, we need to have digital securities because I have a lot of ETPs. They come to me just to do the digital asset custody of crypto, but also at the end they said, okay, Laurent, we also want to tokenize funds in the future. So we need also to have the full suite in Luxembourg to work on digital securities, to have the cash on chain, and this is where you have the solution of Kivalis, but you have other players now in Europe. I understand that KCIs are going to launch one. It was today. I was involved in the one of Société Générale when I was working in Société Générale. You have different possibilities, but definitely the digital securities with a cash on-chain solution is also key for Luxembourg to do the instant settlement, to reduce risk. And at the end, it's always a question of competitivity. So for me, cryptocurrency needs digital securities, and digital securities needs cryptocurrency. It's a chicken and egg solution. We need to have the cash on chain solution. It's not a question. So for me, it's up to the competitiveness of Luxembourg to collectively work together to create this bridge between traditional finance and the new actors in Luxembourg to make us more competitive in the future.
Very good. And actually, as I was listening to you and the others, I was just viewing myself on a different panel, moderating such a panel in Germany or in France or in the Netherlands. And I must say, I'm genuinely quite impressed by the ability to bring together a couple of people here in such a small ecosystem that are delivering so many new cases, are so innovative. So there was just a little reflection that I genuinely just had. To close, and I think we have 5 minutes, if I may, in short answers, and I'll start with you, Laurent, and we'll come the way back here, because you already started with it. What would you say could make Luxembourg even more competitive? Because I think it is already well positioned, more competitive. If there's one or perhaps two things that you would, pass on and pass to the government or the market participants, what else could be done? And secondly, we talked about oceans and drops in the oceans. How do you see, let's say, the blockchain applicability, the applicability of blockchain technology and the volumes on that technological stack in, let's say, Luxembourg, but Europe also in the next 12 to 18 months? Will we see a 0 plus very little, or will it already be a little bit more than that? So not drops, but probably already let's say, summer rain. Perhaps those 2 points quickly.
So if we want to be successful in the future, let's say, we need to continue to work together. I can see in front of me about, let's say, 250 people, but we need to collectively continue to work together, because I think it's one of the strengths of Luxembourg, is the ability to build ecosystem. We have the full ecosystem, so let's continue to work all together and to create new use cases and business model that will make Luxembourg successful. And my second thing will be the regulator, and to continue the dialogue with the regulator, because if all the actors are coming in Luxembourg, it is mostly because we have the regulatory dialogue, and this is for me a very important thing.
12 to 18 months?
I'm doing conferences about blockchain since 8 years, and I'm always telling in 2 years' time I will have the full adoption. So I will need to change a bit my dialogue, and not to say that it will be in 2 years' time, but definitely I can see that now we are definitely moving in execution, because if you see the different news, but yes, we will have large stable coin, and we will have a lot of tokenization of digital bonds and fund money market in the next 24 months.
Super good, thank you. Marcello.
Thank you. I echo what has just been said in terms of in Luxembourg we need to still foster and continue to use the partnership between public and private institutions that we have in the local environment. And in the next 12 to 18 months we need to work on 3 things, let's say. They're all interconnected. I would say liquidity, scalability, and infrastructure. And we have Pontes, which is a baby to bring home, let's say. So we need to finalize it to make it happen.
Super good. Liquidity could come through the real-world assets that get tokenized.
Exactly. I mean, then of course,
that would scale. Then.
Yeah.
Very good. Thank you.
I will repeat again. I think we are all aligned. So for me, it's really continued collaboration, interoperability. We have key players, we have issuers, investors, infrastructure, regulators. Now we just need to ensure that all the solutions talk to each other. So yeah, I would say an integrated financial center is also always stronger than the sum of its parts. And for the 12 to 18 months vision, I expect that we will move from first issuances to a more scalable model on DLT. And now with the arrival of the wholesale CBDC, I see that we will soon see real end-to-end DVP settlement on-chain in central bank money.
It's a big development, yeah.
Yeah.
Serge.
So difficult not to repeat. I think for me, Luxembourg, as all of you were saying, Luxembourg has most of the pieces of the whole puzzle actually to have a digitized financial ecosystem. So I think the collaboration with the legislator is key in this area. The second point that she has been mentioned several times is the interoperability. We need to make our solutions as interoperable as possible. And for that we need a continuous dialogue. And then we've talked about the importance of bringing the cash leg on chain. That's about to come. So these are the three main topics. And from my vision in 12 to 18 months, I would actually tend to agree with what you said. And to repeat what you said, in 2016 I was at a Cybos. I think it was in Geneva, not sure. But the motto there was DLT will change the world. So 10 years later, I think we've done great steps, and I think we'll see more and more issuance coming.
Indeed. Blythe Masters predicted that she would have my breakfast, your lunch, and your dinner at the time, and it hasn't happened just yet. But I wrote to my team on the 2nd of January. I actually remember this well because it was my first working day again. And I said, we've been working on this for a long, long time, and I've always said it's a marathon. For this year, it was the first time I sensed that it was going to be more a sprint year, and it is becoming more, whether it's just the next 12 or the calendar months until the end of this year or the next 12 months, the speed is picking up. We're moving really from a marathon to a sprint environment. And because you so kindly referred to my age by pointing out how long I've been in the industry, I do remember, and many of you remember this in the room, the electronification of stock exchanges. And the electronification of stock exchanges changed everything. If any one of you still remember some of the floor traders, I do. 99.9% of them are not in business any longer, either because they were left behind or they transformed into electronic trading outfits. The reality for them, though, was that they couldn't foresee that electronification would change the way people would trade securities. They could not imagine that I or you would buy more Siemens shares just because you can trade it electronically. And we are in the situation again that we cannot perhaps entirely foresee yet what blockchain technology will actually deliver. The aspect of 24/7, 365, the always-on sort of fractional AI, bot-supported investment strategies. All of this is somewhere at the horizon, but we can't really fathom it yet. But I think there's some music in it. And Luxembourg is well positioned. I think you evidence it. It was mentioned previously, so let's continue to support this marketplace, work together, as you rightly said. Let's scale, interconnect, interoperate, and keep pushing forward here, but with not only speed, but sense of direction. Thank you very much. Bit of applause for the colleagues here.
Many thanks. Before you leave, we have a little bit, a small present for you. Not digital, really real assets.
Not
yeah. Thank you very much.
Thank you.
Thank you.
Thank you. Oh, thank you very much. Thank you. And of course, Dimitri, I forget yours before, also non-digital. Now, oops, where's my... Now we come to the other point, Luxembourg securitization law, 10 minutes, small espresso session. The Luxembourg securitization law continues to evolve, and it's my privilege to be a moderator for this session. We are honored to welcome Anne-George Kusahura, who will provide us with first-hand insights into the new law. Anne-George is the senior counselor, please come already on stage, at Luxembourg's Ministry of Finance, focused on financial regulation. She coordinates the European negotiations on Savings and Investments Union and has led the preparation of the bill updating Luxembourg's securitization framework.
Thank you.
Yeah. Everyone? In the middle. In the middle. And George, welcome, and thanks for being with us.
Thank you. Thank you for inviting me.
Luxembourg securitization law has already been a significant modernization in 22. Now we are looking already at a new draft. Let me start here. What triggered the need for this new round of amendments?
Well, you know, the act was there like more than 2 decades ago, and I compare it a little bit to an elegant elderly lady. You can see the passage of time. You can see that a lot of work has been put into this law, but still it hasn't aged. It has been incredibly resilient, with a really rare balance between flexibility for structuring securitization transactions, but also legal certainty. So it's true that in 2022 we had this rather significant modification of the law. Answering your question, what prompted it again today? Well, discussing with the stakeholders, we felt that there was probably still room to make it more attractive, to make the framework more attractive, more competitive as well, and that probably would be good to have some points of clarification in the law. Not that the law is legally unclear. I think it has proven to the contrary, but rather than by clarifying certain aspects, then maybe we could open new avenues for securitization structures.
Thanks. Before we maybe stepping into the law, when such an initiative starts at the ministry, how does it actually take shape? Maybe you could walk us through who is involved in a project like this.
That's a question I'm never asked, but that's actually very important, and it goes back to the sense of direction that we were referring to in the previous panel. This kind of initiative really embodies the way the Ministry of Finance works, basically in very close cooperation with stakeholders, with industry bodies like LuxCMA, but also with the CSSF. And really, for us, those exchanges are not just formalities. It's really the way for the Ministry of Finance to really stay aligned with the market realities, to see where we can improve when we may have sort of unlevel playing field. And in this specific case, a number of ideas were put forward by stakeholders. We reflected on them, and we felt that there were grounds for actually taking on board some of these.
Yeah. Luxembourg ecosystem being really interconnected, coordination plays a central role. In practice, how complex is it really to align all these stakeholders? You mentioned CSSF, some industry, the ministry, and are there any areas where, let's say, the stakeholders are not aligned? Maybe you can talk about it or not. I don't know.
Sense of direction. Once again, this is one of the beauties of the Luxembourg ecosystem, is that we're fairly aligned in terms of objective. Fairly aligned doesn't mean that we all agree on everything. It's always a matter of striking the right balance. Competitiveness, yes, but not at any cost. Financial stability, investor protections are also very important. And for us, it's very important to have the CSSF on board with whatever amendments we put forward. So yes, it takes coordination. Coordination obviously takes time. As far as we are concerned, Ministry of Finance, we listen, we challenge, we benchmark against other jurisdictions and try to find the best suitable framework for the market to evolve.
Thanks. It seems to be a complex process. And maybe now turning from the how to the what. If you look where we have landed with the draft and what are, in your view, so the key building blocks of the draft, and when can we expect the law to be enacted?
Okay. So yeah, that's a very that's an important precision. It's still a draft law. The government submitted the bill to the Parliament on the 8th of June, so it's in the legislative process. We still have to pass all that up to in particular, the opinion of the State Council, which is very instrumental, very important. So I cannot, it's beyond my control. I cannot say when it will be enacted, but I can tell you where we landed. So in terms of drafting, we have basically 6 building blocks of amendments. Some things that I'm sure practitioners are very aware of, those who do securitization. We have brought a number of clarification on guarantees and security interests that are granted by a securitization vehicle, on the question of subordination of claims of the investors in a securitization vehicle, asset segregation, which is also a very important concept in the law. We have broadened the possibility to do some active management with the underlying assets portfolio of the securitization vehicle. We have made possible intra-compartment in investment, and also we have slightly diversified the possible source of funding. So again, this is a draft law, but stay tuned to see what will come out of it.
Okay, stepping maybe a little bit deeper into the several building blocks. So you've mentioned there are several technical clarification on guarantees, subordination, and insolvency aspects. From your perspective, how important are these in strengthening the investor confidence?
Yeah, well, guarantees given by securitization vehicle, of course, it's basically about enforceability. I mean, investors want to make sure that they are going to that their protection is going to work in practice. You know that in Luxembourg we have the law of 2005 on financial collateral arrangement, which is also very sound, very robust. But it came to our attention discussing with stakeholders that the reform that was introduced in 2022 has made the financing structure evolve a little bit, and therefore we thought it would be good to clarify what kind of security interest can be given in the context of securitization transaction by securitization vehicle to guarantee their own obligation, but also obligations of third parties directly or indirectly in the securitization transaction. So overall, yes, the purpose is to ensure legal certainty, and ultimately it's a key driver of investor confidence.
And legal certainty, that is something which we saw also on the LuxCMA market survey, is really the key issue on the market. Yeah? One of the changes is clearly the extension of active management across all the asset classes, and also a list of categories of portfolio operations that do not qualify as active management. Maybe you can give a small overview and how active management will operate?
Yes. So back in 2022, we a little bit opened the door to active management. It was reported to us that probably it was not enough, and that Luxembourg was at a competitive disadvantage with other jurisdictions which were much more flexible when it comes to authorizing active management. So the bill now acknowledges that active management is possible, and most importantly, that the portfolio of securitized asset cannot be static over the lifetime of the securitization transaction, and that certain adjustments are necessary. So what we have done is that we have opened the door to active management, including for equity positions, which were not included previously. Mm-hmm. And we have listed a number of scenarios, 6 or 7, where it actually does not constitute active management, such as, for example, the replacement of assets that have matured or that have defaulted, or the inclusion of assets in the, during the initial ramp-up phase of portfolio building.
Okay. The other element is, you mentioned it, intercompartment investment, so that one compartment can invest into another compartment, which will probably provide some new structuring possibilities. And can you explain how it will work, and are there any limitations?
Yeah, hopefully it will. It's, again, there was something that that the stakeholders felt strongly about, to allow a compartment of securitization vehicle to invest in another compartment of the same vehicle. We have, of course, some safeguards, such as avoiding a circular transaction when the second one is invested in the first one. We have also excluded public securitization. So that's something that hopefully will provide also legal certainty and operational flexibility for multi-compartment structure.
I think some of the structurers here will use it. I think it's a good element. Another important evolution is clearly the financing possibilities. There is a broadened approach. What does it mean in practice?
Again, stepping back, in 2022, we broadened the financing method for securitization vehicle beyond issuing only a financial instrument. We introduced the possibility for financing through loans and other form of financing. And we have now slightly extended it to other financial commitment. The idea was to take on board, I don't know whether constraints is the right word, but probably let's use constraint of certain investment segments, such as Islamic finance, where the use of loans and traditional financial instrument is prohibited.
So that is more a clarification what already was planned before, but now...
If you ask me, I think it's a clarification, but again, a legal certainty.
Exactly, yeah. Stepping back a little bit, do you see this reform more as closing gaps to other jurisdictions, like Ireland, no? Or are we already anticipating where the market is heading?
Well, I wouldn't necessarily oppose the two. I think it's a little bit of both. Indeed, the idea, as I said previously, was to close a gap to make sure that there were no unlevel playing field for securitization in Luxembourg. But I think it's also about anticipating where the market is heading. And that's why we need this constant dialogue to feel the pulse, to understand where you are heading to, and also to ensure that the framework remains competitive and fit for purpose for the future.
Thanks for listening to the market ministry. And maybe let's close with more general tone. Any final thoughts you would like to leave with us from Ministry of Finance?
Any final thoughts? Maybe echoing what Frank Mausen was saying earlier, securitization is a big piece in the savings and investment union. You know, it's a top priority politically in Europe. Member states committed to implement measures at national level to foster competitiveness and therefore it is our role to create the conditions to make securitization in Luxembourg competitive. But now it's up to you, of course, to make it happen.
George, thank you very much.
Thank you.
Give a big hand for her. Also, little present for you. Thank you very much. We are coming now to our next panel. So we zoom out a little bit. So one of the most important trends today is convergence. Securitization and private debt are increasingly interconnected. Let me introduce our moderator. Louis Kogis is the co-chair of our LuxCMA securitization working group, a very active group in our association. And he's also finance partner at Simmons & Simmons Luxembourg, advising banks, financial institutions across securitization, structured finance and capital market transactions for many years. So if two markets are starting to combine, there's a good chance that Louis Mail has already structured something connecting them, and if not, he has probably a clear view how it should be. Louis Mail and your two panelists, welcome on stage.
Thank you very much, Holger. Convergence play the growing interdependence between securitization and private debt. I'm joined here by my esteemed panelists, Martin Wurtz from Clifford Chance and Natalia Teifer from Loyens Louf. And I will start by you, Natalia, if you don't mind, to set a bit the scene. So we're talking about securitization, and George and Holger just described the securitization vehicle, but there's much more than that under Luxembourg law with securitization. So can I ask you, please, to describe what we have in Luxembourg?
Yes, indeed. Sorry, just probably better to use microphone. All right, let's restart after this technical problem. Indeed, so before we even proceed with talking about securitization and finance, let's see what exactly securitization means in Luxembourg. And why I'm saying that is that it's a source for confusion sometimes. There are two levels of regulation in Luxembourg. One is the EU securitization regulation and one under the Luxembourg securitization law that was just discussed on the previous panel. Unfortunately for all the practitioners, although these two legal acts are very different with different philosophical goals, but also very different definitions, they both use confusingly same term, securitization. So when we now will be talking about the convergence on fund finance, securitization will have to clarify every time what we're talking about, because we will be covering both of these aspects.
Thank you very much, Natalia. Now that we know the differences between EU securitization, or at least I can let you describe maybe the differences between EU securitization and Luxembourg securitization.
Good question. Already there is a big philosophical differences between two acts, because what Luxembourg wants to do is to provide a toolbox that the investors or the sponsors may choose to use, but they don't have to. It's completely voluntary opt-in regime. The EU securitization regulation, on the other hand, is mandatory in its requirements. So if certain criteria are fulfilled, there is no way for you to opt out of it by just saying, look, I don't want it to be applicable. Definitions, again, very confusingly, are very different. So for example, the EU securitization regulation requires there to be tranching, so you need to have at least senior and junior instruments issued by an entity holding credit assets, where Luxembourg securitization law does not have this requirement. So while there is a certain overlap between the securitization under the EU securitization regulation and the Luxembourg securitization law, this overlap is not complete. So you may have a transaction which is a securitization under the Luxembourg securitization law, but not under the EU securitization regulation, and vice versa.
Thank you, Natalia. So now that we know a bit the difference between what we refer to as EU securitization transaction, and we're talking here about the transaction or the operation, we also know what is the Luxembourg securitization, which is more the financing tool. Martin, more focusing now on the EU securitization technique in fund finance and the related financing. Where do we see securitization techniques appearing in practice? How did the fund finance themselves?
Well, I think there are a number of such examples of financing structures involving funds that rely more or less, let's say, on securitization techniques. It has, in my experience, really been fascinating to see how over the years the markets have evolved around credit funds and developed similar structures under different labels, such as, on the one hand, the NAV financings, NAV financing structures for credit funds, and on the other hand, also the asset-backed financing structures, the loan-on-loan structures, all relying or including securitization techniques. Given the topic of our panel being around convergence, I think it's also interesting to take a step back and explain how investment funds have traditionally financed themselves. I think traditionally they have been financed by way of subscription lines or equity bridge facilities, where the lenders made the loans available to the funds in reliance to collateral that was constitutive of the investor capital commitments. But now, for a number of years, the funds have also extensively been using NAV, NAV lines. Why? Well, because at the later stage in the life of the fund, the capital commitments, they have been drawn down, while the fund would still require liquidity, be it for follow-on investments or also capex for the assets that they are holding. So as a result, the funds have used those NAV lines extensively and then also granted security over their portfolio of assets. And also the credit funds, they have used such lines to originate, acquire and hold loans and also other debt instruments, and then granted security over the portfolios of loans or the SPV, let's say, that was created to hold those assets. And I think that's, of course, extremely similar to the constellations that we see in the asset-backed financing stages, so the loan-on-loan structures, where you typically have then the private credit fund that is seeking financing, that sets up an SPV that is then supposed to be the lender of record and is doing the lending to the underlying borrowers, and the SPV being then itself financed or partially financed by often a more traditional finance provider like a bank that may not want direct exposure to the underlying borrower, or that would get more favorable regulatory capital treatment by lending to the asset holding entity. And I think here it's really in response to the fund managers' needs where we have seen similar structures that have evolved under different names and converge to a considerable extent around the credit funds. And it moves this area of fund finance away from the typical commitment-based lending and closer to the structured finance analysis of asset pools, eligibility criteria, tranching, controlling the cash flows that are typical of securitization. And I think as a result of such convergence, there are similar legal considerations that apply to such structures, and in particular from a regulatory and securitization perspective, such as the potential application or not of the EU securitization regulation and the compliance therewith, of course.
Thank you very much, Martin. Natalia, we heard some kind of barbarian words about back leverage in the context of financing, certain financing, and in private credit, private debt. Can you perhaps give a definition, clarify to what it corresponds?
You know how they say that if you have 10 lawyers, you will have 10 different opinions. I'm afraid the same goes for definitions. When we as legal practitioners were not confined by the boundaries of certain legal definition, and there is none, we tend to have very different things in mind when talking about, let's say, back leverage. So when you hear this term, some people may mean something more specific and more narrow in its scope, for example, loan-on-loan financing, when the credit fund is simply financing the loan it's going to grant to underlying borrower with a loan it received from a credit institution. Other people see it in a broader context as all the financing techniques that are available to the credit funds to leverage the loan portfolios, whatever form this leverage can take. And these techniques specifically have in mind the leverage over the loan portfolio, which is secured against the underlying assets rather than capital commitments. So this is very fascinating, as Martin just said, right? Because why it's important, but you look at the credit fund industry we have nowadays, and it's massive. That's the only thing we could say. Right now, we're talking about the industry with 1.5 trillion of assets under management. And of course, the back leverage, so the financing provided to the credit funds to finance their investments, the origination of loans to the underlying borrowers, has been instrumental to this incredible growth. And as I've just mentioned, there are many techniques to structure this financing, right? So again, we're talking about financing provided to the credit funds that will use the proceeds of this financing to grant more loans on the market. So it's, in a way, it's a back-to-back. That's why it's called back leverage. So most of these techniques are using the same methods that fund finance are using, but also the securitization, right, to a bigger or smaller extent. So some of these techniques, for example, are structured intentionally as securitization under the EU securitization law by having different tranches. Like Martin, you just mentioned the EBLs, right, where you always have the junior financing by the credit funds sitting on the top, but also the senior financing granted by credit institution. You can also have repos, for example, so the repurchase agreement, where the credit fund would transfer certain assets to an investor with the obligation to repurchase it at a later stage. You can have hybrid facilities, which are secured against both the underlying loan portfolios, but also against the commitments. And you can have, finally, what I would call a true securitization, where the credit fund would transfer its asset to a bankruptcy remote vehicle, an SPV, which will issue notes to the investors, which, of course, expands the pool of financing available to the credit funds. So it's very interesting both from the sponsor perspective and the investor perspective. Some of these instruments are also rated, for example, which is driven by the regulatory requirements applicable to certain investors that need to hold a certain cushion against their investments, and this cushion is sometimes smaller when they're investing into the rated instruments. So as you can see, it is a fascinating universe, which can have different legal forms, but at the same time, they're using both of best worlds. So the techniques available in fund finance, but also in securitization.
Thank you very much, Natalia. So we had a brief description of what you can do under the EU securitization regulation and the techniques that you have. Now, coming back to the financing tools, and especially the Luxembourg securitization vehicle used as a financing tools, and you may have heard in the previous panel with Anne-George and Holger the coming changes to that particular tools. I'd like to, with Martin and Natalia, to describe where we use that particular financing tool, either above or below some structures. And Martin in particular, in what transaction or structure do we see Luxembourg securitization vehicle, and what practical benefit they bring here?
So then let me cover the upper part of the question. Because obviously there are several use cases for the Lux SVs. I think indeed one interesting example can be to use them as feeder structures, basically that allow then certain types of investors to access the relevant fund structure. As we all know, there are large sponsors that have, of course, multiple types of vehicles, depending on their investors' needs and also preference, how they access the relevant fund. I think this can range from geography also to the type of corporate vehicle that is the most suitable for those investors. But there are also some categories of investors that actually may only invest into debt securities, or at least under favorable conditions. And here then the Luxembourg securitization vehicles could be a good tool as a conduit or repackaging structure to attract such investors, such as insurance companies that have become significant investors over the years. So basically the idea is to interpose a securitization vehicle which will then allow to convert the equity position held in the relevant fund into the notes that are then issued to the relevant investor, and thereby allowing it to get exposure to the indirect exposure to the investments made by the fund.
Thank you, Martin. So you had the upper part. And Natalia, what about where do you see the securitization below a given structure and what it is used for?
Indeed, Luxembourg securitization vehicles is a very flexible tool, so you can use it for different reasons, right? So going down now to the asset level, we often see Luxembourg SVs used as the platform vehicle, so the vehicle sitting underneath the credit fund and holding its investments directly, so either originating loans or acquiring them on the secondary market. There are different reasons why people might opt for that. Of course, compartmentalization, I never can say that. So having compartments is very useful for the investors generally, because obviously it reduces administrative costs. You don't have to set up a separate entity every time you want to invest into different pool of assets. You can just create a new compartment, which literally just take both resolutions. That's all you need. It also allows you to avoid having to fall back to more expensive vehicles like SIFs or RIFs, for example, to have compartments, right? So Luxembourg securitization vehicles are much cheaper to maintain. Of course, you cannot look past the tax treatment of the SVs, provided it fulfills all the conditions. It can be very advantageous to the investors. Luxembourg vehicles are also not subject to the banking license requirements, at least in Luxembourg. Unfortunately, there is no cross-European passport, but in Luxembourg, at the very least, that's one worry you can cross off your list. Sometimes, and I would say maybe in half of the transactions, people can also choose to combine two regulatory regimes, so you can have an SV, which also is an alternative investment fund managed by IFM. That could be, again, for different reasons, for example, for TAT purposes. Again, Luxembourg securitization law allows for so many uses, so we hope that it will stay with this way, and judging by the recent reform, we are going in the right direction.
Thank you very much, Natalia. So I'm informed by Olga that we need to be a bit shorter on the conclusion. But there's still one important point that we would like to underline here. So obviously we're talking about convergence, and there are probably reasons for having such convergence. Martin, can you elaborate just a bit on, and shortly, Olga, sorry, on what is driving that convergence?
Sure, I will keep it short. I think there are two main factors probably, which are the financial regulation on the one hand that applies to the banks, and then really also the growth of the private credit asset class on the other hand. Just taking them very shortly in turn, I think the banks, they face the balance sheet and regulatory capital constraints, and here securitization techniques obviously allow the lenders to manage those constraints more efficiently and get better regulatory capital treatment. That will, of course, be the case if they enter into SRT transactions, but also if they enter into EUSR compliant financing structures, which will then also allow the bank to pass on the more competitive financing terms to the borrower. Then secondly, the credit funds, as Natalia mentioned, they have grown significantly in size and they play really a hugely important role in financing the global economy nowadays. So larger funds and more complex strategies, they require more sophisticated financing solutions, as we have seen. And this results then also in this interdependence between the credit funds and also the banks. They are, of course, on the one hand, direct competitors when it comes to financing corporates, for instance. But on the other hand, they're also really collaborating extensively. The banks financing the funds, but the funds also buying the loans from the banks, from their balance sheets, if the banks want to offload risk from the balance sheet. There are a number of platforms that are set up where the banks, set up by the asset fund managers that basically want to partner up with the banks and then take advantage of the bank's origination capabilities in certain markets, whereas the funds, they have the financial firepower. So all of that creates a nice ecosystem.
Thank you very much, Martin. And if there is one last sentence about the key takeaway for the participant here, Natalia, what would you say?
Look, I would not be a Luxembourg lawyer if I didn't use this chance to promote Luxembourg as a jurisdiction. As, if you allow me to paraphrase Donald Trump, we hold all the cards, right? We are the most, well, one of the most popular destinations for both the asset managers and securitization transactions. We have the relevant knowledge. We have very flexible Luxembourg securitization law, which recognizes all necessary techniques at the level of the law, such as the bankruptcy remote risk, non-petition, limited recourse. All of this should really be used to promote the competitiveness of Luxembourg, so we stay one of the most popular hubs.
Thank you very much, Natalia. And probably one thing before leaving the floor to Holger. As part of the Luxembourg Capital Markets session, we were mentioning the securitization working group. There will be a series of podcasts done by a subgroup that is sponsored by Markus Zenz and Beatrice Ridigel for the use cases. So you will have the ability to access that through the LuxCMA website, and I encourage you, obviously, to look at this. Thank you very much.
Thank you very much, Natalia. Martin.
So we get the gift live.
Yeah,
it's very nice.
Exactly.
Thank you very much.
Thank you very much. Just a quick announcement in between for the football fans. There's halftime between England and Congo is leading 1-0. Yeah. Let's see if it stays until the end. Private credit is no longer an alternative. It's core part of the capital market, and Luxembourg has positioned itself quietly as a leading hub. So our next panel will explore why Luxembourg is so central in financial flow structuring, what regulators are focused on, and how the ecosystem is evolving to support the next wave of private credit growth. I have the pleasure to welcome our moderator, Katarina Volotowskaya, audit partner at Deloitte Luxembourg, with more than 25 years of experience in banks, securitization, and private debt. She leads this securitization practice and works with major international institutions in the market. And I'm also very happy that she's also a board member of LuxCMA and sponsor of our private credit working group. So please come on stage, Katarina, with the other two panelists. You just press it, and then it's...
Sorry, I was saying it's very difficult to beat Congo versus England in this panel. So we prepared, I will introduce my panelists, but we also prepared in the meantime a Slido for you. Please scan the code and let's see what you think. Let me introduce my panelists. Urs is an audit partner at PwC Luxembourg, specializing in private debt and securitization, with extensive experience advising asset managers, fund initiators, and institutional investors on structuring and operating private credit platforms across the full product spectrum, from RIFE to SCSPs to hybrid fund plus securitization arrangements. And Rui is counsel at Deschert, Luxembourg, specializing in fund financing, securitization, and CLO transactions. She advises leading asset managers and institutional lenders on complex, cross-border private credit transactions, including subscription line facilities, NAV financing, and hybrid structures. So we have quite a broad reach in this panel. We'll wait a bit for the final results. So we will start also with a market snapshot and role of Luxembourg. And my question to both of you, Urs and Rui, how would you characterize the current state of the private credit market in Luxembourg today? And what most clearly differentiates Luxembourg from other European hubs?
I mean, I would say if we are looking at Luxembourg from a private credit perspective, we can just look to a pharma, which says about 60% of the private credit funds are done through Luxembourg. So I think we are really one of the leaders. Now we ask ourselves the question, why is Luxembourg so good on the private credit side? I think it's because of our So it's because of our regulator, the CSSF, which gave us a toolbox which nobody else has. So we have the RIFE funds. If you want to set up a private credit fund and you don't have a lot of time, then within 3 to 4 weeks you can be on the market. Then, of course, for smaller structures, we have the tax-transparent SCSP structures. Then we also have a SICA regime, which has some tax advantages if you really do risk capital. And risk capital is not just a private equity investment. It can also be private debt if you give it to the right companies. And of course, we have the SIF fund, which was in the past mainly used, but due to regulatory requirements, which are much bigger than in a RIFE, we mostly see RIFE structures. And last but not least, we also have our interesting securitization structures. But why are those products also interesting? Because you can also passport them. Like a RIFE fund in Luxembourg, it's very easily to passport to other countries.
Thank you. Rui?
Yeah, hi everyone. So from a transactional perspective, we see more and more fund manager choosing Luxembourg for setting up their private credit funds. And the more structures means more transactional work. So we see more and more sub-line facility, NAV facility, and hybrid facility. And we see that lenders are more and more comfortable with Luxembourg entities throughout the whole borrowing structure. And in my view, part of the driving, part of the growing confidence is because we have very robust legal framework, and in particular we have this 2005 financial collateral law, which provides international lenders with a very robust and predictable security package. And that is one framework, legal framework, which is often cited as a differentiator.
Thank you. I think our audience agrees. So we see here the question was by 2030, but I think it's already now that main driver for growth is broad access through semi-liquid and retail investment vehicles, which brings all the diversity of Luxembourg in play. Talking about the structure and setup, and also a question to both of you. Which structures you see as most often used for private credit? And are you seeing more innovative or hybrid setups, maybe fund plus securitization, master feeder, parallel structures? What do you see most in your practice?
I mean, on the audit side, if I'm looking back, probably SIF funds are still the biggest because I have them from the legacy. But if we would look at the projects which happened in the last years, then we have a lot of RIFE funds and also SCSP for smaller groups. But what is even more important are the hybrid structures you talked about. Because we have two ways of having a hybrid structure. On the one hand, we can have a private debt fund investing in a securitization vehicle, and there are a few reasons for that. Why a debt fund doesn't give out credits directly. If he uses a securitization structure in between, he can allocate his money according to the risk he wants to take. Sometimes those funds take the senior tranches, but most of the time they take the junior tranches and leave the senior tranches to banks, what is also very interesting for them. In addition, it has another remote bankruptcy remote structure, where it's also really good, and also one of the key points for Luxembourg, because Luxembourg remote structures are more interesting than in other countries because the enforcement is easier on that point. And of course, it also helps to provide operational efficiency if the fund invests through a securitization vehicle into some assets, because not all the structuring and the follow-up needs to be done at the fund level. Of course, we also have it the other way around, that the securitization vehicle invests into a debt fund. This, as our colleagues before already discussed, is one of the things for insurance companies, because you can move it to a lower capital requirement, and also even for banks it can give a regulatory advantage, because you can rate a securitization vehicle, and if you take a high tranche with a good quality, then you have a higher rating and lower capital requirements on the banking side. Of course, you can also use a securitization vehicle to make assets available for investors which would not be allowed to directly hold these investments. There are maybe some Part 1 funds, etc., who can use an indirect structure for an investment. And of course, you can also make the asset more liquid. If you have a private debt fund, you cannot sell it every day, and it's usually not traded on a stock exchange. But if you have a listed note on this asset, you can easily trade it and transfer it. And that's one of the key reasons at this point.
Well, from my view, as Urs said, SSP remains attractive. REF regime is popular. But sometimes SCA could also be an interesting choice. And we think that there are many factors to be considered, like investor base, underlying investments, and also tax and regulatory considerations. So there is no one-size-fits-all answer. We see in the market a rise of hybrid setups. For example, the Luxembourg securitization vehicle, which can be used for structuring the rated notes feeder, and to just add a transactional layer to what Ux mentioned. So the European insurance company, subject to the Solvency II, and Asian institutional investors, subject to similar local capital framework, face restrictions on holding fund equity directly. And but they are well positioned to invest in rated notes, which carry more favorable capital treatment. And we also see in the market the first private credit CLO established as a Luxembourg style, and which leveraging our updated securitization framework, which permit active portfolio management for debt securities, and to be confirmed in the near future to other assets. So whether or not it relates to the rated notes feeder or CLO, it is ultimately to match the structure to the investor's regulatory reality or commercial appetite. And the Luxembourg, we believe, has the vehicles and the legal framework and the ecosystem to make it work.
I think I will continue, Roy, in this direction. From your experience as transactional lawyer, what are the main regulatory matters that come up in private debt transactions?
Well, as lawyers, there are a lot of regulatory matters we have to consider. Just to name maybe two, that come through very frequently in the practice. I would say the first is the EU securitization regulation. In many private debt transactions, one of the first questions we may ask is whether or not the deal falls within the scope of this regulation. The answer may be not obvious, and the analysis must be case by case. But the consequences are real, is that if the deal falls within the EU securitization regulation, the 5% risk retention requirement and the mandatory reporting to competent authority will apply. So it requires, in practice, in-depth analysis and discussions between parties to find a workable way for everyone. And the second, I would say, is the AIFMD2, under which the loan originating fund are now facing statutory hard ceiling on leverage, 175% for open-ended funds and 300% for closed-ended fund. And which means that the leverage testing must happen at a very early age of the structure and not at the end. And on the other hand, a loan originating fund who originates for the sole purpose of transferring their loans to third parties must retain at least a 5% notional value of the loans, which is a skin in the game requirement, similar as the requirement under the EU securitization regulation. Yeah.
Thank you. Maybe now we can look forward into what we think about will happen on the market. Also have a question for you. In terms of risks. And the question is, what do you think will be from product side and from what needs to be done in Luxembourg side? So what do you think will be the biggest growing segment of private credit, real estate, mid-market corporate lending, infrastructure, net asset value financing in Luxembourg in the next, let's say, 5 years? And what do you think, from your perspective, regulatory tax or market practice matter necessary to keep Luxembourg competitive as a private credit hub?
I mean, if you're looking at the Luxembourg market, I think where we really need private credit might be in the real estate market. Because if you're looking back at the Luxembourg real estate market, normally you sold on paper, so 70% of your building was sold by the time you started your build a house, and now nearly nobody wants to buy really apartments if they're not yet built. I think this is one of the areas where we really need the private credit market maybe. A second point is, if you're looking at the banks, we see how difficult it is currently to receive credits on the real estate side again. So maybe we need to have something to do with the NPLs on the Luxembourg market. Because you don't have NPLs or NPA securitization on Luxembourg market because there were no NPLs in the past. Because usually you recovered the money over the time. But now my question would be, maybe it's time to look more into NPLs, securitizations on the Luxembourg market. And of course, another big subject is infrastructure financing, but that not only at the Luxembourg level, but even at the European level. And I think Luxembourg can really profit from that. And what I would wish is flexibility from the regulator to support us on this journey.
Well, from my side, looking ahead, we are observing from our practice that there are more and more NAV facilities and secondary market liquidation solutions appears to be among the most active areas. Both require the kind of creative and the multi-layered structuring, which Luxembourg is well positioned to support. And from my view, I think that the Luxembourg's competitive edge is not any single vehicle or any single regulation. It relies heavily on the predictability and the legal certainty. So maintaining that regulatory and the legal certainty will keep the deals flow coming to Luxembourg instead of going elsewhere. So I hope that is how the next success story will be written.
And I think our audience believes that the biggest risks, economic downturn and regulations, where we have a lot of regulation, it's true, and we want on one hand side them to be stable, on the other hand side we want them to be flexible. That's right. And maybe to conclude on this panel, why we talk so much about private credit and why actually it's the first time in this 5th edition we talk about private credit as part of Capital Markets Day, because now it's established as a real big segment of private market. I think it's this year officially overtook real estate globally as a asset under management. Natalia mentioned 1.5 trillion. There is latest data I saw, it's more than 2 trillion globally as of now, with forecast that it will double by 2030, and we definitely want to be, as Luxembourg, in the middle and center, spearheading this. And I think we have all that we have on the market, all that necessary to be the leader worldwide as a private credit hub. Thank you.
Thank you.
Thank you.
Thank you very much. Liz? Yeah. Thank you very much. We're coming to the end. Ladies and gentlemen, we have covered the full transformation journey tonight, from money to infrastructure to regulation to market innovation. And one thing is clear, capital markets are developing fast, and Luxembourg is right at the center of it. It's now my pleasure to hand over to Katrin Fortberg-Müller, our LuxCMA Vice Chair and partner at DLA Piper, Luxembourg. Just as the other board members do not know which song I kick off, we do not know how Katrin will present her closing remarks. Will it again be a poem? Let's see.
Let's see, indeed. Good evening, everyone. We're here in the Philharmonie, one of Europe's finest concert halls. So after last year's poem, I close this edition on a slightly different note, a musical one. Because when I look back at the conversations we've had this afternoon, I realize that the themes our speakers explored today have a way of showing up in the most unexpected places, even in the lyrics of the greatest songwriters. They just didn't know they were writing about capital markets. We opened with Dimitri Patin and the ECB's vision for tokenization, cross-border payments, and projects Pontes and Appia. A whole new settlement infrastructure for Europe. If that's not reimagining the system from the ground up, I don't know what is. Or as David Bowie put it, turn and face the strange changes. And changes there are. The question is no longer whether digital settlement will happen, it is how fast. Then our first panel took us from framework to execution, scaling digital securities right here in Luxembourg, DLT moving from a proof of concept to production, Clearstream, the EIB, Spurkis, LuxCSD, Standard Chartered, all on stage, all building. And who better to soundtrack a session on digital infrastructure than Daft Punk, a duo who were, after all, entirely digital themselves. Harder, better, faster, stronger. That's the mandate, isn't it? Not just digital for digital's sake, but digital because it is genuinely better. And Luxembourg is already leading the charge. Next, our espresso session on the securitization law reform. Guarantees, security interests, subordination, and broader financing methods, including intra-compartment investments, another genuine modernization of the framework. Securitization will always be about the transfer of risk, but what makes Luxembourg special is that it keeps adapting, reforming, modernizing, listening to the market, so that this jurisdiction remains the place where you want to structure that risk. As Eminem put it, you can do anything you set your mind to, man. And Luxembourg has set its mind to staying ahead. Then came the convergence panel, securitization meets private debt. Two worlds colliding, merging, creating something new, hybrid structures, new investor dynamics, creative solutions. The Spice Girls, stay with me here, were remarkably ahead of their time. Two become one. I'm fairly sure they weren't talking about loan on loan, but the point stands. And finally, private credit, no longer the alternative, the market. Luxembourg as the hub for structuring, managing, and scaling private credit platforms across Europe. Tina Turner asked the big question, what's love got to do with it? Well, in private credit, quite a lot, because it's all about relationships, trust, and long-term commitment, rather like a good marriage, only with better documentation. Luxembourg Capital Markets Day, 5 editions in, this event has become something genuinely special. And that's not because of the program, it's because of the people in this room. More than 200 professionals who chose to spend a Wednesday afternoon thinking about what comes next. Regulators sitting with practitioners, lawyers with bankers, innovators with pragmatists. That's how progress actually happens. Not on a blockchain, but over a conversation, and shortly, over a glass of wine. Frank Sinatra closed every concert the same way. He would sing, I did it my way. Not quite done. Luxembourg has always done capital markets in its own way. Pragmatic, open, international. And today showed that this approach is not just surviving the digital age, it's thriving in it. So as we move into the Grand Foyer for drinks, I will leave you with one last lyric. The Beatles, who knew a thing or two about collaboration. I get by with a little help from my friends. And that's the truth of this industry. No deal closes alone. No structure launches without a network. No regulation lands well without the dialogue between those who write it and those who live with it. So go into that foyer, find someone you haven't spoken to before, and become their little help. That is how capital markets actually moves forward. Thank you. Enjoy your evening.
So, thank you very much. We see us outside. Yeah.